All right, welcome back to another episode of the Black Bullion Show. Should gold really be as low as $13.50 an ounce? Well, Scotiabank says so, and I say no. Now, before we begin, I just want to say if you are new to the channel, please subscribe. Also, please give the video a thumbs up, a like to help get this economic evangelism out there to the masses. And just want to say if you would just like to get a quick video synopsis without having to watch the full thing, check it out in the description below. Now, okay, so why does Scotiabank say gold should be at $13.50 an ounce? Well, it's because of one particular metric. And I'm going to read a brief paragraph for you to highlight this. But the metric comes from Scotiabank in this article by Kitco News, and essentially the metric is basically looking at the investor inflows, the central bank buying, and also general physical demand in jewelry. So let's take a look at what Scotiabank said. I quote, "By this approximation, the loss in physical demand at this rate is 5 times larger than the increases in investment demand. But gold is up 11% year to date. The correlation between these dominant drivers and the annual gold price performance is positive 0.56, which puts the model implied gold performance using the past 10 years of data at negative 12%, i.e. gold should be closer to $1,350, showcasing a larger disconnect between the negative omen from the physical backdrop and price action. Unknown over-the-counter flows stemming from strategic and or official sector explains not all of the part of the difference." So according to Scotia, this one metric with only a correlation of positive 0.56. Now, if you guys are familiar with correlations, the range is from -1 to +1. So this correlation is at 0.56 positive. Basically what they're saying is this is enough to take gold down nearly 22% from where it is right now to $1,350. So I say no to this. Why? Well, not only because of there being many factors that contribute to the price action of gold, but simply I can challenge this with just one metric. There's one metric that's way more significant than this metric that they came up with here, and its correlation is stronger. Now, you may have an idea of what I'm going to be getting into, and it is this. It is real interest rates. Now, real interest rates have a correlation with the price of gold at a negative 0.82. Now, you may hear that if you're not a math person and think, well, that's really low. That's close to -1. Now, don't worry about the negative sign, because that can easily get flipped. Because what actually makes the gold price go up are weak real interest rates, let alone negative real interest rates. So with negative real interest rates, you're going to have to turn that negative into a positive. When you have negative real interest rates, the more they increase, the more the gold price increases. And it does that at a correlation of 0.82, which is way stronger than 0.56. Now, again, this is just with one metric. Now, here I'm reading from an article, just a brief sentence, where this comes from. It comes from an article called "The Golden Dilemma," written by Claude Erb and Campbell. And they found that a near perfect negative correlation of negative 0.82 between real interest rates and gold prices between 1997 and 2012. So yes, the range of time isn't that long. It's from 1997 to 2012. But what Scotiabank was looking at wasn't too much of it wasn't too off. It was from 2008 to 2020. So that's roughly a 12-year range. And here we have a range that's roughly about 15 years. So not too far off. So in my opinion, with just this one metric, we can completely just, toss that notion aside of just saying like, hey, if it weren't for the current sentiment right now, gold should really be at 1350. When honestly, you can just look back to, prior to the sentiment, gold was going up, and it was going up because of negative real interest rates. Or I should say it was going up because of lower real interest rates, depending on what year or what time of the year last year you're looking at. Real interest rates might not have been negative, but it was still low. Right now, it's negative. So, what do you guys think? Do you think that this metric is enough to bring down this metric that Scotiabank brought up is enough to bring down gold nearly 22% to $1,350 an ounce? Or do you think that there are way more factors that go into it? And one of the strongest factors that gold has to its pricing is negative real or weak real interest rates. Let me know in the comment section below. Thank you again for watching this video. Please give it a like. Please subscribe if you are new. Thanks again. It's Black Bullion.